In August 2022, the Biden administration enacted the Chip and Science Act, a substantial piece of legislation spanning 1,054 pages. Regarded as the most significant U.S. industrial policy move since World War II by the New York Times, this act aimed to curb U.S. semiconductor investments in China and impede its technological progress. Contrary to its intended goals, the Chip and Science Act has resulted in severe repercussions for major U.S. chip industry players. The market is currently experiencing a distressed state, with significant drops in U.S. chip prices attributed to inventory pressures. CNN reports that the reduced demand for U.S. chips from China, coupled with the unattractiveness of the CHIP Act, has led to U.S. companies facing the consequences of their own actions. The financial impacts on key players are substantial. Intel, a giant in the industry, witnessed a staggering $6 billion drop in market value last month, accompanied by a stock decline surpassing 6.4%. Qualcomm's Q1 2023 financial report revealed a 12% year-on-year decrease in revenue, marking a decline in traditional strongholds like mobile and automotive chips. This, in turn, has eroded investor confidence, resulting in a roughly 3% drop in Qualcomm's stock price. The repercussions extend beyond mobile chips to the PC chip sector. AMD, in its bleak Q4 2022 financial report, recorded a staggering 51% decline in revenue from the PC chip sector, leading to extensive layoffs. Even industry giants like Intel, Qualcomm, and AMD, which represent the pinnacle of profitability, are facing severe threats, underscoring the grim challenges confronting the U.S. chip industry. To alleviate the situation, the U.S. chip industry has been compelled to reduce product prices multiple times. Despite these efforts, they are grappling with unsold inventory. The Wall Street Journal notes that chip products from U.S.-based Texas Instruments have undergone multiple rounds of price cuts ranging from 30% to 90%. Yet product shipments have decreased by around 30% compared to the same period last year. The challenges faced by the U.S. chip industry also extend to graphics card giant NVIDIA. Despite significant performance improvements over the previous generation, new graphics card sales are meager, failing to bring substantial profits to the company. The core issue at play is the combination of overcapacity and insufficient demand, signaling a precarious situation for the U.S. chip industry. The Biden administration, in response to these challenges, has injected over $50 billion into subsidizing U.S. chip companies since late 2022. However, this might not be a sustainable solution if the fundamental problem of finding sufficient markets for us chip companies is not addressed. The significance of the Chinese market cannot be overstated. In 2022, China's total chip imports reached 538.4 billion units, making it the world's largest chip importing country. Over 60% of global chip industry products pass through Chinese customs, making it a crucial source of profit for U.S. chip giants. However, the Chip and Science Act has caused us chips to lose access to this promising market. China's changing data reveals a shift in its dependence on U.S. chips. From September 2022, China's monthly chip imports have decreased by 10% to 15% compared to the average for the first half of the year. The total chip import volume for the whole of 2022 decreased by 97.2 billion units compared to the previous year, reflecting lackluster sales of U.S. chip giants. China's domestic chip industry is gradually replacing the position of U.S. chip giants, with the domestic production rate accelerating. For instance, the shipment volume of China's domestic mobile chip enterprise, UNISOC, has grown significantly, with its domestic market share increasing from less than 1% to 11%. A stark contrast to the plight of us chip enterprises. The Biden administration's attempt to revive the U.S. chip industry through government subsidies raises concerns. While injecting funds might provide temporary relief, the core issue of finding sufficient markets needs addressing. Otherwise, government subsidy funds could translate into more chip production capacity, further exacerbating inventory pressures. The impact of the Chip and Science Act extends beyond the realm of semiconductor chips. China, in response to U.S. sanctions, implemented export controls on highly sensitive graphite materials and products, as well as natural flake graphite. This move officially took effect on December 1, 2023, indicating a tit-for-tat response to the measures imposed by the Biden administration. China's monopoly on critical materials like gallium and germanium adds another layer to the geopolitical dynamics. In 2022, China accounted for 98% of the world's gallium production and 68% of refined germanium production. Despite efforts by Western countries to establish alternative supply chains, China's dominant position hinders the success of these endeavors. The tone of US media remains relevant, drawing parallels between China's control over highly sensitive graphite items and its previous control over gallium and germanium exports. This strategic move aligns with the broader context of the US increasing export controls over chips, leading to China's responsive actions. The complex interplay of geopolitics, export controls, and market dynamics paints a challenging picture for the future of the US chip industry. The Biden administration's Chip and Science Act, while attempting to secure technological leadership, seems to have inadvertently triggered a series of events with far-reaching consequences. As the industry grapples with overcapacity, weak demand, and geopolitical tensions, a comprehensive and nuanced approach is essential to navigate these turbulent waters. The evolving landscape underscores the need for policymakers to carefully consider the interconnected nature of global markets and the potential ramifications of unilateral interventions.